Hello, and welcome to Mayor Brown's podcast series, Credibly Challenged. This podcast focuses on risk management issues for financial institutions of all sizes, particularly those in the banking sector. My name is Matt Bisanz, and I'm a bank regulatory partner in Mayor Brown's financial services practice. Joining me today is Jim MacDonnell and Ariane Chapelle. Ariane is the CEO of BDO Chapelle, a risk management consultancy in Europe, and author of an authoritative treatment on operational risk management practices for the financial services sector. Jim is a managing director at BDO US, and he focuses on risk management and business continuity issues. On today's program, we'll talk with Ariane and Jim about their experiences in operational risk management and how they work with banks to improve risk management practices. Thank you both for joining us today. So to get started, I think we'll tackle some high-level questions about each of you maybe could give me your philosophy for managing risks. What do you tell your clients about how they should focus on risk management issues?
All right, I'll take that one. Good morning, good afternoon, Matt. Hi, everyone. Look, in risk management, the first thing I tell my colleagues and my clients or my students is about proportionality. Basically, small risk, small fuss, big risk, big fuss. You don't want to over-control the little issues, over-control the daily volatility and waste resources on that, but rather you want to concentrate on the tail events, on the scenario analysis. And we had so many crises in the last years and months that it really validates the approach on focusing on what can go really wrong in organizations.
And I would build on that with three general rules that I like to recommend everybody keep in mind. The first is that risk management shouldn't really be cyclical. It should be continuous. A lot of organizations fall into the trap of, okay, once a year it's risk management time, but I think that we all appreciate that in this environment, the risk environment is always changing, and you need to really incorporate it into your culture and just the way that you operate. The second is that a lot of risk management professionals get so deep into risk analytics, because that's where we all like to nerd out, that we forget that the most important part of risk management is what the heck are you going to do about it, right? And making sure that you are actually implementing effective strategies to manage your risk rather than just getting really, really deep into the analysis and making sure that your list of risks are pristine and exactly right. And the third, which is actually kind of related to the second, is when it comes to risk analysis, at least in my opinion, is eventually there's a diminishing return on investment, where if you start to get too deep into quantitative models and trying to make sure that everything is absolutely defensible at all costs, you probably have just gone way down too deep into a rabbit hole, because there's so many underlying assumptions associated with all of these things. And if a risk is number 7 versus number 8, you're like, who really cares? Is it something that you need to take for action or not? And I think that those are really key things that a lot of people lose the bubble on.
Mm-hmm. That's good to hear about prioritization and understanding the magnitude of the risk. I think that's something often lawyers can get hung up on, that we struggle with prioritizing and saying, well, this is a significant legal risk or this is an insignificant one. That for us, it's, well, are you complying with the law or not? If you're not complying with the law, that's bad. And we are hesitant to put a proportionality around it. And I think regulators also, particularly in some of the check the box exercises that are more common in the United States, that can be a thing. When the examiner comes in, they have a list of procedures they're going to perform. They perform the procedures. And if the bank is out of compliance on something, well, that's a big deal, even if that particular procedure is a relatively immaterial issue. One thing, though, that those regulators, I think, are focusing on, at least in the U.S., and maybe isn't the best proportionality, particularly in light of recent events, is around stress testing and scenario analysis. That there's a huge cottage industry. I think probably BDO helps with some of it on the bank side, advising banks on how to do stress testing, on how to do all that quantitative analysis, on how to put in place all those kinds of controls. And it really gets into those extreme weeds that you're talking about, where a single assumption can change the outcome, but it doesn't change the risk. How are you working with clients to maintain that proportionality, but also satisfy regulators who maybe don't have that same practical experience?
All right, so I'm gonna take that one, and building on what I find very interesting comment from Jim on analysis, and not to be too precise, precisely wrong, rather than roughly right. Look, I'm a big fan of risk quantification, but not in any way, and without being too technical, but roughly, you don't use your past losses, you don't use the past in risk management to predict the future, and largely, actually, it's the entire prediction of the future, because when you had a previous large events, if you're Société Générale and you lost 5 billion in rogue trading, the last thing that will happen to you in the years to come is rogue trading, because all your controls focus on that. So it's actually, the past is about the worst predictor of the future when it comes to operational risk. And I completely relate to what Jim was referring to in terms of the model that went a bit haywire, a bit too pushy, and frankly quite wrong. What I would insist on, and what I do work on a lot with firms in Europe, it's the ICAP. So ICAP is Internal Capital Adequacy Assessment process. By looking at structured scenarios, and I've worked on similar projects in the US as well with in a previous life, let's say, and really focusing on the drivers of risks, on what causes what, and monitor the causes of your risks, the drivers of your risk. Now, you can do it quantitatively or qualitatively. You can do it quantitatively to look at what your stress testing will go and will look like, both in financial risk and non-financial risk. We are living in a high inflation environment, stagflation environment, on the 70s coming back to bite us. So there's a lot of reasoning to do on what these external environment, both political, ecological, and financial, influence the drivers of these risk-funded firm, and how we're gonna either model that to assess your capital and please the Fed or the ECB, the European Central Bank, or to do it qualitatively to know what to monitor in your institutions in order to be prepared and to be resilient. I think that's a topic also that we're going to discuss today.
Yeah, and just to add something else on that topic of resilience, we are also seeing a focus on other types of testing. We all know that DORA is rapidly approaching, which for anybody who doesn't know, requires failover and operational resilience testing of your information and communication technology providers. I think that even with hosted systems for a lot of financial institutions and really across all industries, organizations are struggling to figure out how good is good enough. What are the appropriate validations when you're testing your resilience plans as well? And what are the regulators going to continue to expect to see in the future? Because, let's be frank, that is a little bit of a moving target as well. And when you consider the different regulations across the UK, the EU, the US not really adopting an operational resilience, framework quite yet, it is difficult to figure out how you design good programs that will appease different regulators and fulfill your shareholders' expectations as well.
Yeah, and I think that we have in the U.S. done things in a sort of haphazard way for many years, at least from a legal perspective, and it sounds like from a risk management perspective. Again, we've not always worked in lockstep. I was looking at Ariane's book on operational risk management, and I was struck with the fact that it's really a unified theory of risk management, that she ties together some of the things around risk appetite, around risk mitigation, around risk quantification in a way that just doesn't really exist in US regulation. When you look at something like the OCC's heightened standards or the Federal Reserve's enhanced prudential standards, there really isn't that continuity across the risk stripes, across connecting stress testing to control practices. That doesn't really exist. And touching on something, Jim, I think you were talking about with operational resilience, is that historically, at least in the US, things like business continuity and operational resilience were overseen by one team within a bank. And then there would be another team that would oversee financial crime risk. And those might be former law enforcement people or accountants. And then there would be a different team that would oversee capital and credit risk. And that would be some actuaries and people like that. And these silos worked on their own risks, but not in a really efficient enterprise-wide manner. Do you have any advice for financial institutions when they are now trying to link up these different teams within a bank or break down the silos to better manage risk?
Yeah, so that is a situation that a number of organizations are struggling with right now for a couple of different reasons. One, it is hard right now in the market to find the broad expertise of people that really understand how third-party risk management or vendor risk management, business continuity, disaster recovery, operational risk management all work to be able to pull them together. And when you take a look at the interagency paper on sound practices to strengthen operational resilience, which was pushed out here in the US, they do have some good recommendations and guidance around collaboration and integration and information sharing across these other domains. But one of the biggest hindrances that we see within organization tends to be structural in nature, or quite frankly, personal in nature. Everybody wants to protect their budget. Everybody wants to be able to plan effectively and drive their unique perspectives forward. And sometimes that does lead to struggles to take a step back and say, hey, what is good for the organization more broadly speaking, and where should we be investing in 1 year versus another year? Because it is a increasingly complex environment that, quite frankly, nobody, I think, has got a slam dunk right now on saying we've got the perfect risk management model that meets all of the global regulatory requirements and leaves zero chinks in the armor, especially with large, complex multinational banks. I mean, it's exceptionally hard to manage an organization of that size on a good day, much less on a bad day as well.
Yeah, on that note, and I would link to the topic of size, it's much, the smaller you are, the easier it is to do risk management. And you can, you know, almost start from a white sheet of paper, or your legacy is a bit lighter, or you can get rid of it and really start from a risk strategy. I started by talking about proportionality, but linked to that is the risk strategy. What's my business strategy, and what are the priorities of my risk management that will support and basically capture the upside of risk and the upside of the uncertainty and try to limit the downside as much as possible. That's what everybody wants. And you know, I completely agree with Jim. The bigger you are, the more complex the relationships and the coordinations of this is. And what you also observe in the US more than in Europe, and when I talk to my colleagues and peers across the Atlantic, there is, and it's a good thing, but there is a specialization of the different branch of risk management and in general, and operational risk or non-financial risk in particular. So when I started operational risk management, that was basically when the industry started 20 years ago, and operational risk management was this sort of, you know, blob of heterogeneous, a little bit of everything. And now you have way more specialization, as you said, in financial crime, in AML, in TPRM, third-party risk management, model risk management. And in a sense, it professionalized itself, if I can say. So that's a good thing, because the practice of risk management in terms of its sophistication and understanding, going back to what I said about the understanding of the drivers, is improving. Now, of course, the flip side of this is that you need to coordinate all these new specialized profession. And, you know, one of the, I guess the only thing I see for now is to have this, what also you see the trend of this ERM, this enterprise risk management, that will try to have a coordinated approach across the non-financial risk and also the financial risks. The next step would be, how do you harmonize the approach to financial risk management and non-financial risk management? But I guess we're not completely there yet.
Yeah, I think one thing that you mentioned that's important is figuring out where you are coming in a business that like you said, similar to lawyers, your profession is often hired by one specific part of a business. Maybe it's the risk department, it might be the internal audit department wants you to come in and look at remediation, or maybe the business has been told to map its procedures and build controls, and so you're hired directly by the business. And my perception is that there are an increase at larger banks, there are an increasing number of disagreements among the lines of defense, among the different units, about what is a proportionate way to understand risk and manage risk. And how do you manage those relationships when maybe you're representing one part of the bank, but you're still trying to think about the bank on an enterprise-wide basis, and like you don't necessarily have a dog in the fight, but you do have a goal of protecting the business?
That's a great question, but before I answer it, I actually want to go back to something that Ariane was just talking about. So I have seen some statistics that say that, typically speaking, large financial institutions spend anywhere between 3% and 5% of their revenue on various risk management activities. So when we think about, just from an operational efficiency perspective, being diligent in how your risk programs are structured, having a good understanding of their roles and responsibilities, how they are spending money, is something that we are seeing organizations focus more and more on, because, you know, there are typically opportunities for significant cost takeout, you know, and across risk management more broadly. And the second thing that I will point out is we are seeing a change in the chief risk officer role as well. The chief risk officers are increasing on driving operational efficiency, collaboration, and being a little bit more deliberate, instead of just, you know, being the guy who makes the final risk decision around risk appetite on a day-to-day basis, actually really driving towards information sharing and collaboration. So as to your most recent question, and how you break down those silos and advocate and effectively advocate for whoever you're representing, usually our perspective is we need to start at the top and get a good understanding of the risk culture. And even driving things like a consistent risk lexicon and a consistent methodology across the organization can help bring some degree of parity to those discussions. Because, you know, it's not going to be any surprise if you go and talk to somebody who deals with public relations, they're going to care about brand and reputational impact. And if you go and talk to somebody who works in the business continuity program, they're really just going to care about business continuity. But even within specific domains, so Ariane brought up third-party risk management. If you think about all the different services, vendors, products that you may be acquiring on a regular basis, not all of them present the exact same risk profile. Not every, you know, provider has as significant a risk around money laundering or FCPA violations as other ones. But what's really challenging is that when you think about vendor risk management, it is not uncommon to find out that your cybersecurity guys are really worried about your vendor cybersecurity program, and your privacy team is worried about privacy, and your business continuity team is worried about operational resilience, and you may have an ESG team who's worried about fulfilling your ethical, you know, standards. Right. And they all may be operating in completely different silos. So I almost feel like the first step is even just understanding how risk management is typically structured across a financial institution and who else you need to talk to from the get-go. And then the other piece of it is, I think, walking into these conversations with a perspective that somebody probably already is working on a very similar solution. And ultimately the organization benefits the most if it is with a mindset towards collaboration rather than, I have my priorities and my priorities will always be the priorities across the organization, because we find that that's typically not true.
On the relation with these risk specialists, the second line and the first line, so the so-called business, this is a topic that is daily to me. Okay, so typically I'm called by the second line, sometimes by the third. Sometimes I do audit, an internal audit for operational risk clients, but typically it's the second line that is calling me or calling us to benchmark their practice, add some sophistications in their approach. And they almost all have the same issue, is to get accepted and to be heard by the business and to find their place and so that risk management is not resented. So, and I feel for them, because when I started my career at ING as an risk manager, I was part-time for 11,000 people. I was coming originally for audit, and I had to be accepted by the business. And so, over the years, I've been training the second line to really speak the business language, and proportionality helps. And, being less technical, wrote papers on invisible frameworks, or not pushing the technicalities of risk management on them, and really positioning risk management in a positive way so that you actually help them by listening to what their concerns are. And a number of the risk practice that Jim mentions in terms of, what is the continuity, or what's the continuity of my third parties? What if I have a critical business services that is not delivered because my third party goes belly up for whatever reason, or is victim of a ransomware, if we think of recent events in the US, etc. All of a sudden you are talking about their concerns and how you help them. And so I don't like this expression of killing two birds with one stone, but you're reaching two goals at once. That's much better. Right. By at the same time answering the business concern and helping the risk team to find their place in the organizations and to be heard.
Yeah. That's a great summary of almost your day to day. And it's clear you've developed this over the 20 years or so that you've been building this profession. It's my perception is that in Europe, you guys are further along than in the US in building this profession. And in the US, we struggle in part because we just have financial institutions of so many sizes that a small community bank in the Midwest isn't going to have the risk profile as a money center bank in New York City. So a lot of our laws and guidance, Jim is probably really familiar with the TPRM guidance from the bank regulators. It says things like you must consider the business continuity risk of your suppliers. But it doesn't say you need to make them have this kind of return to operation standard, or you need to get this amount of indemnity from them. Ariane, when you're thinking in Europe about looking for guidance for to operationalize your advice for your clients, where do you look? How have you decided you need to update it? Are there standards or guides that you look towards?
Well, my go-to documents is BIS, is the Bank of International Settlements and the Basel Committee for banking supervision. So these provides the international guidance to all regulators, the US, Asia, and the ECB. So on continental Europe, the European Central Bank, and EBA, European Banking Authority, in the UK, the PRA and the FCA are really taking their guidance from Basel. And in a sense, we're helped, or at least in my perspective, we're helped in Europe because it's a lot more principle-based than text-based compared to the US. And many of my friends and professional friends over the years work in the different instances of the regulators. And I'm not very compliance driven, to be honest. I don't have an eye for details, and I completely relate to what you said about the non-proportionality of lawyers, coming from a lawyer's family and having to deal with lots of contracts, especially recently. I can totally relate. And so what I ask my regulatory friends is like, look, and I'm talking very much from a European perspective here, If I manage my risk as, genuinely, with genuine intent, if I, really try my best to be comprehensive in my risk identifications and diligent in my assessment, not in a procedural way, but in a well-intentioned way, do I respect the spirit of the law, if not the letter of the law? And all of them said yes. And I've always managed my, services and project like that. And, so far it works. So there is something to say about the genuine intent and the power of genuine intent when you manage risk, at least in Europe.
And Jim, unfortunately, you and I are not blessed with such a principles-oriented framework in the U.S. At least I always feel like I'm on a more prescriptive end of things. But how do you operationalize your advice in such a different climate than what Ariane has?
Well, I think what Ariane was just saying around the intent is really important, because my perspective is there are a lot of different strategies that organizations can typically employ to deal with the same problem. So you brought up vendor risk management, for example. Is it a valid strategy to diversify the vendors that you're using? Yes, absolutely, right? You have two vendors, that reduces your risk that both of them are going to be operationally unavailable at any given point in time, with some caveats around extended enterprise and, all the other deep nerdy things that we could get into when you start talking about vendor risk management. But you could also argue that it's an equally valid strategy to put very, very fierce contract terms in place to help to incentivize them to do all of the right things, because if they're unavailable, granted, there's some limitations with that. I don't know that, the large internet service providers or cloud providers are going to vary, their contracts that much for anyone just because they're so big. But you could also say that it is a valid strategy to kind of do the trust but verify, where you want to get vendor questionnaire responses back. You want to see proof of failover testing and all of those things. But really, the ultimate goal for all of those are just different strategies to drive towards reducing the risk that a operational disruption from one of your vendors presents to yourself. So that decision point, though, around is it good enough, is a very personalized and specific decision to a given organization based on their unique risk profile, right? We hear like a lot about benchmarking and, I should always do this, but that's just not the way the world works.
To take a slight pivot, Jim, there was something in your background that I found really interesting. It was on threat management. And from time to time, I get questions about ransomware issues from financial institutions, often, thankfully, on the front end before they've had an attack, but I'm sure you see a lot more on the back end once they've had that. And there's kind of a struggle on the legal side of things that the regulators say we don't support people paying ransomware to shady persons. I think OFAC has said you never know if they might be a sanctioned person, but also under U.S. law, it's not illegal to pay a ransomware. And so a business can face this existential choice of, well, do I take the risk that I'm paying a sanctioned party and not pay it and go out of business, or do I pay the ransom and really hope it's not a person on the SDN list? And so when you're down in the weeds there on that ransomware threat management, how do you help clients deal with the proportionality of, maybe we'll say, the legal risk versus the going concern risk as a business?
Well, I think that most organizations, pragmatically speaking, if the choices are suffer some financial penalty or cease to exist as an organization, are probably going to lean more towards running the risk of facing a penalty for making a payment. But more broadly speaking, I think it is important to appreciate the fact that the regulatory environment is dynamic and is changing. There's been a number of versions of legislation that have been floated to ban the payment of ransomware. I think that depending on the industry, if we look outside of financial services, that's going to continue to change, right? We know that there's the CMMC requirements for folks working with the Department of Defense. The SEC is getting involved. There's just a lot of things that are changing, more broadly speaking, and that's having a knock-on impact that's influencing that strategic decision-making. So I'll just use insurance for the time being. Right now, a lot of cyber insurance policies do cover the payment of the ransom, and they cover the payment of a lot of other, adjacent things. That's probably going to be changing over the next few years. And the extent to which that will change the decision-making process is unique. But, this is a lot of words to, I guess, get around to the point of the most honest yet unsatisfying answer that a consultant ever gives. It depends, right? It depends on how bad the situation is that you're in. It depends on when it happens. It depends on how much you do or don't know about the bad actor. It depends on how prolific across your enterprise the ransomware has spread. There's a lot of influencing factors, but I think that most organizations ultimately, at the end of the day, take into consideration their shareholders, the ethics that they hold true to themselves, and a lot of other factors to make those decisions.
Well, thank you for that. That was helpful. As we're getting close to wrapping up, I am appreciative of your time, but I would wonder that in recent weeks here, we've had some interesting developments, most notably on the US side. Thankfully, I think, Ariane, you in the UK and Belgium have been relatively unaffected by some of these things in the US crises sector. But do you either of you have some maybe commentary or thoughts about where things will go from here for banks that are dealing with interest rate risk?
Well, I would probably limit my comments to just broader statements on what I think we're going to expect to see around risk management, not necessarily specific to the interest rate risk, but it tends to be cyclical. We all know that risk management tends to be cyclical. Something bad happens, people invest a lot of time, money, effort, focus into risk management, things get better. You bring your cognitive biases into the conversation because then all of a sudden it seems like nothing's really happening. You start asking yourself some questions. Why are we spending so much time, money, effort, and conversations around this? Nothing bad ever happens, and then inevitably something bad happens again, right? It's this cycle that risk management professionals, I think, are all familiar with. And just the fact that, risk management professionals are in such high demand right now is going to be another factor that large financial institutions, small, mid-sized financial institutions are all going to be taking into consideration as they compete over the same talent. I mean, we've seen coming out of COVID, situation in Ukraine, business continuity professionals being in very, very high demand. And as the situation continues to get more complex, everyone is going to be fighting for talent, more broadly speaking.
Yeah, Matt, we might be sheltered for now in the UK where I live and in Belgium where I work, but Europe is definitely not sheltered completely if you look at what's happening in Switzerland and to many of my friends. But look, it's an interesting time, even though it's a terrible time as well for all of those involved. But another name of the financial services sector is interest rate sensitive, and I think that's a very stark reminder that it is indeed very interest rate sensitive. And I was talking about proportionality and the need for proportionality for firms to look into in terms of risk management, and that's I think undeniable. But the same goes for the regulators, and we have witnessed over the years a re-regulation that is now lasting for almost decades, up to the point that you wonder how far they can go. My suspicion / hope, so reprogram that in a year or two, see if I was right, is I actually anticipate some sort of deregulation in a sense of the regulators moving away from the detailed approach in order not to lose sight on the big picture. So again, going back to proportionality, my fear when you over control legal things is because it sucks up resources out of the big picture. And I was actually talking and training a regulator on their own ERM yesterday. I won't mention who, but one of the key risks on their key radar is to miss a supervision. It wasn't in the US and it wasn't in Belgium or the UK. There you go. The bets are open. So it's quite high on the radar of the regulator not to have banks failing on their watch. And so that's one aspect. And when you see what's happening in Switzerland and you see the the FINMA and the Swiss authorities moving so fast to avoid a new great financial crisis 2.0 at the scale of Switzerland and contagions in Europe. It looks though, even though there's ups and downs, the sector and the macroeconomy does learn over the years, and it's trying not to repeat the errors that we've seen in 2007, 2008. So hopefully there will be some progress there.
Yes, well, I think we all will keep learning. That is definitely a constant of my career, and it sounds like it has been for both of you. I want to thank both of you, Ariane and Jim, for participating in the Credibly Challenged podcast. It's been great talking with you. I also want to thank our audience. Without you, we wouldn't have a reason to be here. I hope you enjoy these podcasts and stay tuned for the next episode.